What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is July 27th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's update, I want to spend some time not only to talk about the significant price action we've had over the last 36 hours as we approach the upcoming Federal Reserve FOMC meeting. And all the while it might sound boring, it might sound too macro, this is an incredibly significant event for both Bitcoin and the broader asset markets, including stocks as well. And I want to spend some time to talk about how we should go into this meeting, not only with expectations, but also where price will likely head towards. We've got a lot of things to dive into. Let's go ahead and kick things off. And if you guys enjoyed the video, consider dropping a like. Now, let's go ahead and start off here by focusing in on Bitcoin's price. One thing we had discussed is that although it's not always true, and I'll get to that in a moment, the general rule here when we have an accumulation channel, so focusing on these two lines here, this kind of zigzag pattern here where price is pushing sideways, there's no clear trend direction after a very clear decline or bear market in any given asset. When we tend to find that price is pushing sideways through an accumulation channel, anytime we deviate outside of that trend, whether it be through the previous line of support, as we saw back here many times, and also through the line of resistance that usually holds price down, as we can see many times over the past few weeks, we tend to find that when we deviate back into the channel, we are going to go all the way down here towards the support range. But a very important thing to note here is that unlike the previous few times, where within a matter of a week or a few trading days, we signified a clear continuous downward move here back down to the range of support, this time around, we've seen not only a much bigger deviation from the upside, but a lot of buyer strength coming in here, showing us a candle pattern here that we have not seen in either scenario beforehand. And that's why I think it's very important to think about what we should expect coming out of the FOMC meeting here, to see that buyers are coming in at this range around 21,000, or excuse me, around 20,700 to 21,300, and they're coming in strong. That is a really telling sign that we are likely not coming back down to this range here at 19,000. We'd even talked about the idea that we were going to start to break away from this trend. Eventually, you got to break away from a channel in either direction. And the bulls carry through a lot of confidence and a lot of volume here from July 13th all the way up towards July 20th. And we had talked about 20K being kind of the bare minimum target. And the reason for this is because of the continued resilience and strength we've been seeing in Ethereum against Bitcoin. Take a look here at the strength here on this ascending line of previous resistance, now coming in as support, holding up Ethereum's price here and setting up the stage to hopefully break above 0.07 on the ratio and climb higher. Again, no matter if we do or not, it's very clear here that we've been able to gain resilient strength here on both the 200 EMA and the 200-day moving average. Really solid stuff. This is, again, what you see when you have a risk-on market. Now, I want to go ahead and dive into equities here as well. A little bit of a tidbit before we dive into the real macro perspective later on. When we take a look at the NASDAQ 100. If we take a look at the NASDAQ here on the daily time frame, we not only have been able to see buyers coming in here within this pocket, which was serving as previous resistance over the past few months, and now potentially could become new support in order to set the foundation to come up towards our target range at around 13,500 sometime here within the month of August, coming in between the 200 EMA and the 200-day moving average, just like we did during the previous relief rally back in March 15th towards March 30th, around 15,000 on the index. So this is exactly what we want to see. We want to see higher lows, higher highs here, price making support at previous resistance in the past, signaling that the market wants higher and that it's anticipating the Fed, all the while it's been talking the talk a lot over the past few months, that it's likely going to start walking the walk backwards, that it is going to start lowering its interest rate hike expectations because it believes that it has been able to contain inflation. Now, I understand that we're still obviously feeling the pain here, But what the Federal Reserve is going to probably depend on here is that the numbers that we've seen here are delayed as we go into the CPI report for July. We get them eventually for the rest of the coming months, with oil prices and natural gas starting to cool down from their all-time highs, energy-based commodities in this case. We know that the CPI is going to read a lower level, that it is going to start to decline. With oil at around $90 a barrel, it's practically guaranteed that we're going to see this, as food prices and other types of commodities have started to cool down, and their year-over-year growth has started to slow. And this is going to give the Fed all the room to be able to give short-term relief. The Federal Reserve, if you've learned anything from the Fed over the past few years, they will take any opportunity to ease within the economy because they like to stimulate asset markets, and of course, as they've stated, they want to avoid a recession. But deep down, the Federal Reserve knows that they need to eventually put us into a recession. That's why we see this as a relief rally in the market, a short-term rebound where equities and cryptocurrencies get confident and people start to think, oh my gosh, this is where we kick off the next bull run, where we're going to shoot up here all the way up back to the previous all-time highs and go even higher than that. But in reality, this will be yet again another relief rally in the market where we face chop and resistance at that line and start to go back down as the economic data, more quarterly earnings, and inflation numbers come into the picture. Because once the Fed starts to cut back on its hawkish nature, the demand will come straight back into the economy, and there will still continue to be an imbalance between supply and demand as there is now. There's too much demand in the market to meet current supply. Now that doesn't mean we can't take advantage of this relief rally and that we shouldn't set our sights high here in the short term up towards this $13,000 range on the NASDAQ. Or in the case of Bitcoin, that if we get out of this pocket here, of this accumulation, and we're able to come up and bounce off of it, that we could come all the way up here towards the upper $20,000 range, around 27,500, 28,000, or even up here towards 30,000, retesting that 200-day EMA. I wouldn't be surprised by it. Again, we really shouldn't be too shocked here if we see that kind of resilience coming back into the market here, especially seeing how price is yet again hanging around the 200 moving average on the 4-hour time frame. There is still a chance here. Again, when we look in the past at these moving averages, we tend to find that price faces them as resistance. Now there's a bit of chop here. We're starting to see if the bulls can actually hold up to their promise here and take prices higher. And take a look here at what altcoins are doing in the market. We've got altcoin dominance still churning higher here. Its highest level since back on May 9th. And we can also see the total 2 measurement, the entire altcoin market, minus Ethereum and stablecoin liquidity, and we divide it by Bitcoin. We've still got a lot of strength here, still holding up at a range we saw back here in late June. So we've been basically holding neutral here against Bitcoin. As Bitcoin has generally been going up in price, we've seen altcoins keeping up just as well. And we're talking about really the altcoin market here. That's the important thing. So in dollar terms, a lot of these plays are rising up. And I think that we've got the play here to continue carrying up above the 200-day EMA and MA for a continued relief rally. And again, a lot of people are going to think when we come up to this point here that price is just going to continue climbing higher here. You've got all the right narratives. You've got the ETH merge. You've got the idea that the macro environment and inflation are starting to cool down, that we're starting to get more equilibrium in supply and demand. And it's not to say that we couldn't be heading towards that, but to be honest with you all, as much as I like the merge, as much as I would hope inflation is cooled, to be honest, the merge doesn't matter too much right now. Ethereum as a network is quite scalable for the use of the network right now. Not to mention, having one of these launches in a bear market is not going to have the same effect as it would being into the later stages of a bull market. And second off, it's important to understand that the macro environment is not ready to take severe long-term exposure to risk on assets like crypto. I'm just being honest with you guys. As someone who loves to ride the waves of bull markets and is always going to be here through good times and bad in crypto, we'll continue to cover it here on the channel. But I got to be honest with you all, as we get this potential second bump up here in altcoins against Bitcoin and their ratios and increased dollar valuations, I'm going to be taking advantage of that strength. There are very few plays in the market that I think will actually hold up well. And if I'm looking for those plays in the market, I'm looking for those that are holding fundamental value propositions, ones that are doing things different in the market, not only in the efforts to scale their networks, but most importantly, to offer developer flexibility and allow for unique applications to be built on their networks. And that's why today's sponsor for our video, Kava, is one of those plays that we're watching. If you haven't heard about Kava just yet, Kava Network is one of the leading Layer 1 blockchain protocols that's aiming to merge the power of two of the most powerful Layer 1 ecosystems into one singular network, the Ethereum virtual machine, the EVM, as well as the Cosmos SDK, giving developers the ability to not only build applications in the native language frameworks that they're used to on either network, but to be able to have these interactions of these applications in developer ecosystems, allowing for unprecedented new utility-based applications in the DeFi space. Now this, for me, is really exciting. We've been watching Kava for a long time here on the channel, but don't just take my word for it. To be honest, what I think speaks the most volume here, seeing as Kava has only launched just a couple months ago, they are already the 17th largest when it comes to assets on the network, or total value locked. If we take a look at the expanding ecosystem here, you not only have a competitor to MakerDAO, the Kava Mint, where you can lock up Kava tokens and through a collateralized debt position, mint USDX, the platform's native stablecoin, but also you can activate and utilize platforms like Kava Lend and Kava Swap, as well as MoneySpace, in order to access the core DeFi applications that you've come to know and love. And we can see that even with the market drawdown here in crypto, when it comes to dollar-based valuations, TVL is holding up quite strong within the Kava ecosystem. We can also see that the amount of Kava on the network is holding up strong as well. And this is mainly due to the expansion of the applications, not only through the Kava platform or what we saw on the Kava website, but also what other people in the community are starting to build. I'm very excited to see the launch of, in this case, Kava's CDP product that allows you to actually mint your own native stablecoin. I think that's imperative to build a native DeFi ecosystem, and I'm really excited to see that Kava's put a big priority on this. So if you guys are interested to learn more about Kava, check out the link down below in the description. Follow them on Twitter like I am, and definitely keep up with the exciting updates that they have. I think this is a really interesting experiment to add in the Cosmos SDK as well as the Ethereum virtual machine into one singular network. Now, continuing on this conversation here, guys, about the resilient strength we've been seeing in the altcoin market and a lot of the other metrics that we're keeping an eye on, I want to go ahead and step a little bit into macro conversation here. We have all the right things here for the Federal Reserve to stick to a 75 basis point hike versus a 100 basis point hike. We have, for example, not only crude oil here holding right on the 200-day moving average. Still, as it is holding here, we don't want to jump the gun too much on what it's going to do, but setting up the potential foundation for a breakdown lower here. If we just simply take a look here at the longer term chart, take a look at the weekly here, right? Turn off our drawings, get off the log scale, and just really take a look here at the chart. This just doesn't look bullish here. It looks like it wants to go lower and at least find support down here at $85 a barrel. And that gives us a couple of weeks, all we need for that relief rally to play in markets. And then soon after that, as everyone's getting optimistic, thinking that the worst is behind us, that we're charging forward, that is when we are taking profits, that is when we are de-risking, and that is when we're going to cash and waiting for lower price entries in the market. And it's simple. This is that principle, not getting caught 2 steps behind, taking advantage of market euphoria, a return to normal, at least what people think is a return to normal, and starting to look for value opportunities, as oil and natural gas will likely probably come back up to some degree and hover around this $100 range for some time. That is, again, going to happen probably in the coming weeks and months. It's not going to happen overnight. So just bear that in mind. We've also got, again, a weakening strength here overall within the Forex markets. between the dollar against other major currencies. As we can see, the dollar has gained massive strength against the Japanese yen, but it's starting to show signs of weakness here since it peaked back on July 14th. We can see the same here with the euro as well, even though, again, we got a nice rebound the other day, still showing here that the momentum is starting to potentially stall. And I want to go ahead and talk a little bit about why this might be here. And putting aside all of our subjective opinions about what might happen and why it happens, what's really interesting is that in this article from Markets Insider, they wrote about a really interesting point. While there are no guarantees that the broad market indexes, the S&P 500, the NASDAQ, etc., will rally or rise into the Wednesday meeting here that'll be in a couple of hours, they noted that the S&P 500 had rallied in response to all FOMC actions over its past few meetings. Since the latest rate tightening cycle began in March, the S&P 500 has risen by 2.24%, 3%, and 1.46% respectively on each of those Fed days. And those have been some of the strongest reactions since as far back as 1994. Because, and we need to understand this dynamic here, the Federal Reserve has been incredibly aggressive over the past year in sticking to its commitment to cool inflation and starting to raise the federal funds rate in a response to this inflation. Any sign that the Federal Reserve is not going towards the direction of 1 basis point hikes per FOMC meeting, which is very hawkish and very aggressive and very tightening on the economy, and is starting to look potentially towards, no, we're going to stick to 75 basis points. And in fact, we think we're cooling inflation down enough to where we can just do 50 basis points or 25 basis points. That is going to be all you need for equity markets to have their summer relief rally. Even a hint that they're starting to look in that direction versus going higher and feeling like they don't have inflation under control, that is going to be exactly what the markets want to see. Because it is going to give everyone the sign and hope that the Federal Reserve has cooled inflation, that it is confident it can reverse trend. Little do they know, though, that back in the 70s and the early 80s, inflation went through multiple waves, even as the CPI started to cool down and the inflation rate in the economy started to lower. We set a higher base foundation and continued back up into double-digit inflationary territory. And I think that history is going to repeat itself because the Fed falls into the same trap each and every time. It's kind of like, for example, having a messy room, right? You don't want to clean up the messy room. It's a lot of work, but eventually it's just going to get really messy, and you're going to eventually have to clean it up. We are eventually going to have to go into a recession. We are going to have to see a long-term sustained pullback, but it doesn't have to happen overnight, and there will be periods of relief where we see, for example, a weakness in the dollar index providing relief to global markets that the Federal Reserve is not going to raise its rates so chaotically to the upside. Same here with the U.S. 30-year yield. The bond market is pricing that the Federal Reserve is going to be cutting back its aggression on rate hikes. If we continue to see a decline here like we did back in June of last year with the U.S. 30-year yield coming down here towards around 2.7, that means that the market is generally pricing in a much lower increase in the federal funds rate, all the way from potentially here at 3.5 at the peak, already down here to 3, potentially down to 2.75. That'll mean that the market effectively, albeit it's not exact, is estimating that around 75 basis points worth of hikes are removed from where we thought we would be heading back here in June of 2022, over a month ago. The fact that we're already down 0.5% on the 30-year yield speaks volumes about what the bond market is predicting the Fed is going to do. Right now, if we take a look here at the monthly chart, we can see that we've not only faced significant resistance at that 200-month moving average, that is highly significant, but on top of that, we've got a long way to go here until we find some kind of range of support. Maybe here at 2.7, right? Down here at 2.4, who knows? This, to me, signals that the market is starting to price in the Federal Reserve later today or during the next few FOMC meetings, a discussion point about cooling the growth of interest rate hikes. rather than taking them to 75, 100, or even more. The Federal Reserve is going to take a very confident stance today. And I think that that is coming through a lot of the moves from the White House and the other financial advisors in the economy that are saying, oh, 2 quarters of GDP decline, that's not a recession. All these kinds of things that are going to try to ease people's concerns. And to be honest, it might just work here in the short term because, to be honest, this recession, like all others, is unique in its own ways. And this one is an extraordinarily unique recession. We've got incredibly low rates of unemployment, albeit, of course, there is a very low level of job participation, even considering the levels we had before the pandemic. But all these things considered, it's all the things that are required for a relief rally. And it's going to carry equities and crypto likely higher, but for just a short little while. And we need to take advantage of that strength in the market. When others are going to be flipping their tune, going from being permanently bearish to permanently bullish, we need to look the other way. We need to be able to be smart with our money, protect our capital, because right now interest rates are high, and even if the Fed starts to slow down the rate of growth in interest rates, it still is a difficult environment for assets to truly expand long term. And the Federal Reserve can no longer substantially maintain 0% interest rates like it did for the last few decades. It is going to have to keep them suspended for a long period of time, increasing the cost of capital and keeping asset prices weighted lower. Anyways, I've rambled on long enough, guys. If you made it this far, please consider dropping a like if you enjoyed the video. You deserve a medal for making it this far. And if you guys liked what we talked about throughout the video, let me know down below in the comments what you think on it. Whether you agree or disagree with me, would love to get a conversation going on what you think is going to happen in the FOMC meeting. But I've rambled on long enough. Have a wonderful rest of your day, guys. Until the next one, I'll see you all in the next video. Take care, everyone.